Welcome to Trading Nation. I'm Mike Santoli. Amid the market's recent bout of volatility, one thing seems clear. Investors are flocking to quality. Quality stocks are those that typically boast strong balance sheets, little debt, and are less reliant on the economy. Citigroup naming McDonald's, Pfizer, and Procter & Gamble as just some companies that fit this bill. So what does this trend mean for the market, and should you pile into this quality trade? JC O'Hara is with MKM Partners, Boris Schlossberg with BK Asset Management. Talk about that. Boris, I mean, implicitly, this is kind of a defensive strategy. It's what you would see ahead of even rougher times for the market. Do you think that makes sense here, or is the market giving you a chance to kind of re-risk with some cyclical stocks and buy those stuff that's not being bought right now?
No, I think it's a good strategy. I mean, these stocks are sort of the quintessential Warren Buffett stocks. They have great brands, a really good moat, very sustainable business model, and strong history of dividends and earnings. So they generally make very good sense to own for the long run. But now especially so, because the market is very volatile, as you noticed. And in times of volatility, in times of stress, quality always outperforms. So a potential trade of long quality short the market, I think, is actually a very good trade. It's probably going to have continuous positive returns for the time being.
All right, yeah, that would probably actually be a bear market trade if it comes to that. JC,
I guess so, yeah.
You know, healthcare has been leading sector actually through this year. It does kind of check off a lot of those boxes for these quality attributes. Do you see anything in there that makes sense at these levels?
Absolutely. You know, I think a giant misperception is quality equals boring and stocks that move left or right. And that's actually not true at all. There's plenty of strong momentum sort of names within the quality basket. You know, one example is within healthcare, and it's Pfizer. If you look at the longer term chart of Pfizer, there is a 15-year base where this July, price rocketed out of that base, breaking above 37, and it ran 20%. If you take another step back and we look where it can go, we have to go back to 1999 and 2000 to find, you know, the next level of resistance, which is around $50, which is another 13% from present levels. So to us, that's very, very exciting. Secondly, another chart that we find within the quality basket that we find very attractive is McDonald's. I mean, McDonald's was up 40% last year, spent a lot of time consolidating those gains in a wedge formation this year. Now, typically when price forms a wedge, when it breaks out, it acts like a spring and it rockets higher. And we saw just that. McDonald's up 13% off the October lows. So another one of these strong breakouts. So again, there's great momentum within this quality basket.
All right, maybe somewhat boring companies, but not boring stocks all the time, I guess is the lesson. JC, Boris, thanks a lot for joining us today. And thank you for watching Trading Nation. I'm Mike Santoli. We'll see you next time.